Hello, thanks for tuning in to this Market Outlook video. My name is Alyssa Neese, and presenting today is Asi de Silva, our Chief Investment Officer here at Capital Squared Financial. For those of you who are less familiar with our firm, Capital Squared Financial specializes in retirement planning. We specifically work with individuals and families who are planning for, transitioning to, or are in retirement. We also offer proactive tax planning, multi-generational planning, and each of our clients has an individualized investment strategy that matches their overall financial or retirement goals. We serve over 80 families across 13 states and currently manage over 200 million in assets. And now, jumping into our topic for today, Asi, take it away.
Thanks, Alyssa.
Yep.
Hey, everyone. Good morning. Recording on the 23rd of April. Just, this is our quarterly update. I'm going to go straight into my slides, and these bullets give you a handle on what the following 15 or so slides will cover. The overall message really is that the global economy faces a new headwind in terms of energy prices. Uh, Markets have ignored this, assuming things are going to normalize, and we're at all-time highs in US markets. The overall message is that's probably premature. Sure, it could resolve tomorrow or the next week, but we don't know that. We're already 2 months into this very high energy price environment. So be cautious when others are greedy is kind of the one of the takeaways or one of the underlying themes of this slide deck and my message. I want to just start off by highlighting how the US consumer is not as exposed to transportation fuel. Yes, they're exposed, but I think the key message from this chart is that exposure has probably halved, has halved over the last several decades. Everyone looks at the 70s and 80s is like, oh, it was a big shock having higher oil prices. But this is government PCE data. It's showing it's, just under 2%. This is direct consumption. I think the more serious implications are the indirect impacts on inflation because crude oil goes into almost every manufactured good and it goes in via transportation and wages into essentially all goods and services. These price increases take time to come through, but when they come through, they're much more pervasive. So maybe that's why the markets are looking through because it's not necessarily as good as thinking about the long term. So this, I think, is a risk, and it's particularly a risk as oil prices stay high for a longer period, and we're 2 months in. The US consumer also has a nice tailwind right now, which is higher tax refunds from the one big beautiful bill tax policy that was passed by the Trump administration. This is, you can see the chart. This is from the Wall Street Journal. And this benefit is notable in the first half of 2026. Tails off after that. Yes, some of this additional cash is going to buying gasoline, particularly for the lower end consumer. But all else equal, it's a nice positive we have at the moment, and we shouldn't be surprised that first quarter earnings that's underway at the moment is coming in pretty good. The next few slides are going to touch on a theme we have highlighted for a few quarters now, right? This is the uneven economic consumption in the US. You can call it K-shaped economy. And this particular chart looks at the savings since COVID, how the top 10% of earners have an outsized share of the excess savings compared to the bottom 90%. And I think what's also more interesting is how, yes, everybody benefited during the early part of COVID, but then in the bottom 90%, those excess savings have been whittled down and there's not a huge cushion now. It's all at the top end. Drilling down further, what this means is, top left chart here looks at the dotted reddish line is real growth in real disposable income, and the blue line is personal consumption. And so you've the US consumer, yes, it's strong, but it is consuming more than their income. So it's consuming from savings. This chart on the right side shows how the savings rates have fallen, but this is the K-shaped economy. The top 10, 20% have savings. That's where the consumption and spending is robust. Same thing, credit card spending. The high income cohort is spending more and more. The lower mid-end growth of consumption is much lower. And finally, this chart from data from Moody's, the top 20% of the income tier accounts for almost 60% of income. Um, just it's working for the economy right now, but I think we can all agree this is unhealthy when kind of 10 to 20% of the population accounts for such a large percentage of the income. And this is a theme we've been highlighting for a while now. Um, in an even more granular level, this is a story I was reading in the Wall Street Journal some weeks ago. The room revenues from the luxury category of hotels has grown 9 times faster than economy hotel revenues. Are you surprised? No, kind of, it's the same theme, but this is what we're seeing. Despite all, well, not despite, maybe in addition, you're also seeing margin balances for stock trading or securities trading go up. It is not as alarming if you think of margin balance as a percentage of income from or the balance of stock value, but in absolute terms, it's going up. And so perhaps a decent amount of the stock investing is coming from that cohort that does not have the excess savings, and so they're borrowing. And this, I think in aggregate is a higher risk for the markets because if there is a pull down, you're forced to sell. And again, I think ties in with consumption being tied to the upper brackets and the rest of the population having to borrow or struggle to keep up with consumption. The second area that I think we're all familiar with, and you hear it in the media, is this AI CapEx boom. Started off really inflecting in 2024. It's continued into 25 and 26, and the projections are that it continues to rise, even though there are bottlenecks in kind of power availability, the turbines to generate that power, etc. Um, like the consumer, this CapEx boom, if you look at overall CapEx, is kind of a stool with one strong leg. And here's that broader view of overall CapEx, right? So data center CapEx is booming. We can debate. We won't even debate. We will know in hindsight whether this is overdone or not. And obviously the market currently thinks it's not overdone, it's needed. But then if you look at all the other structures, it's pretty lifeless, right? So again, you have a consumer that's very skewed to the top 10 or 20% of the population. You have CapEx that is dominated by a single industry. So overall, uh, not the most dynamic economic underpinnings. And that, we take into account as we think about our asset allocation, what to buy and what we probably should be underweighting. The other area that we talk a lot about with AI is, well, wow, we're losing lots of jobs, right? Because the media really highlights announcements from the large companies. Some of them are saying, "Oh yeah, we're gonna go because of AI, we're gonna lay off large numbers of employees." You don't really hear as much in the media from what's happening in the small business space, and that's where the bulk of the employment is created. What's interesting is if you listen to the media narrative, you would think one of the areas that's worst impacted is software engineering. And what this chart, excuse me, shows is that this is job postings on Indeed, the hiring website. You've seen since kind of middle of last year when ChatGPT and AI really started to get into the mainstream, you've seen a fairly sharp pickup in job postings for software engineers. It is quite incongruent with the narrative. Like this is an area that's really struggling. So just keep that in mind, where oftentimes the narrative is does not keep up with the reality on the ground. And so this is quite heartening to see that there is not a tail off in at least job postings for software engineers. The other broader message on the employment sector or jobs in general is that we have been conditioned to think that the economy needs several hundred thousand jobs per month to keep up with new employment or new workers coming into the job force. Well, what's happened is with a sharp decline in immigration and the overall demographics is aging. That hasn't changed. The If you look at the middle of this chart, the US needed anywhere from 100 to 200,000 jobs a month to keep employment flat, meaning fully employed. With the drop in, this is a Federal Reserve study, with the drop in employment, immigration, the estimates now are anywhere from 0 to 25, 30,000 jobs needed to break even on unemployment. Keep the economy fully employed. You actually probably don't want job growth getting back into the hundreds of thousands because that would be a highly inflationary environment because there is not a labor supply coming in, which is historically, I mean, when I say historically, for decades really now, has come from robust immigration, and that seems unlikely to change, certainly for the next 2 years. Switching over to stocks and in particular earnings. Uh, this is a chart of S&P 500 company earnings, Wall Street estimates. The estimates in light blue are Wall Street estimates. Actual is how they report. And this last bar chart shows that, even with energy prices going up, both for the current quarter and for the full year of 2026, earnings are remaining quite solid and at the margin going up. But here's why I wouldn't necessarily trust that or extrapolate past into the future, given what's happening, what's likely to happen with margins and economic slowdown globally. If you look at the history, Wall Street had very robust estimates leading into 2025. When the Trump tariff uh, issue started, they sharply cut estimates. This is the trend down into the middle of 2025, when in fact the reality was, earnings didn't fall that much. So now Wall Street is ramping up earnings, and presumably just when the global economy is facing a headwind, margins are going to face a headwind because of higher purchasing, PPI and energy costs. And there's, decent likelihood that this actually goes down, even though at the moment we're focusing right here and going, hey, earnings are great. So keep this in the back of the mind, or we certainly do as we think about stocks, particularly US stocks, because that's the earnings picture here for the US companies. We're going to end with a chart or two charts that we have touched on before in these quarterly updates, and that's the question of international and emerging markets. We did increase allocations in client portfolios at the start of 2025, so some time ago, into international and emerging markets. That for the last 12 to 18 months has done particularly well relative to the US. But what I'm trying to highlight is the light blue line is just the absolute emerging markets stock index, right? And if you pull up international, meaning developed countries as well, Europe and Japan, the charts look very similar. What is more interesting is how, relative to the US, this dark line, you're just starting to see the pickup. So there is room for this trend to continue for a long, long period. And that was part of the thesis we had, except that with high energy prices, we're going to pause and reevaluate because these markets are far more exposed to energy prices than we are in the US. This is not to unwind it, it's kind of take a fresh look, see what the future holds, because if you have $120 to $140 oil, which is where the physical market is for an extended period, say another 6 months, these economies, many of these economies, not all of them, could be more impacted. And lastly, on emerging markets, I glibly write not your farthest emerging markets. And that's because many of us think of emerging markets as, oh, it's got cyclical, lower quality companies in the index. And it was certainly the case, 10, 15 years ago, where 25 to 30% of the stocks in the index were energy and material. But if you fast forward to today, in fact, the energy share has dropped very low to about 10%, and you've seen technology driven up to 30%. And so, the perception we have is, hey, technology is high growth, and I'll be happy to pay a higher valuation multiple for. And that actually is true for emerging markets, even though they trade broadly well below US stock market valuations. If there's a downside, you just need to be aware that this is now highly exposed to the AI CapEx trend because the bulk of that rally has come from three stocks in Taiwan and Korea that supply the chips into AI data centers. So far so good. They've done it very well, but double-edged sword. I think on a net basis, I think it's a positive that you have emerging markets that now also has pretty significant exposure to technology. So brings us to the conclusion. I think the overall message, which I want to reiterate, is that the global economy has a significant new headwind since the start of the year, energy prices. US stocks have looked through this, assuming the conflict ends today, maybe next week, and maybe that happens. But the reality, it has not happened. We're 2 months in, and that's both a demand shock in terms of consumption and global growth overall, but also will probably be a margin hit as well. US stocks are really not positioned, at all-time highs for higher inflation and higher rates. Deficits are also likely to tick higher. President Trump has now proposed a 50% increase to defense spending for the next budget. And that at the margin will worsen the rate pressure for rates. The new Fed chair is talking a fairly dovish view on rates. Maybe we'll see what happens if he does get confirmed. But I think overall, we'd want to, what we talked about in stock ideas, I want to lower the exposure to higher rates, which skews us towards value and dividend companies. And also, we're back up at at all-time highs. Maintain the capacity to add. We managed to do that for our clients who wanted when just recently when the S&P fell almost 10%. And on the international stock front, we want to evaluate, where this energy picture, how it evolves. It's international's done well, but we do know that those economies are more exposed to higher oil prices. On fixed income, this is what I've said for several quarters, maybe actually more than a year now. You want to have some inflation protection and some growth slowdown or recession protection. And that means owning TIPS, short-term and intermediate-term treasuries. Given our worry about all-time high debt levels and this deficit spending, we have avoided long-term treasuries or long-duration bonds. A brief note on private credit because it's in the headlines over the last 2 months or so. We have not allocated clients to private credit. We did not think it was the right category. My only point is I don't see it as a systemic issue that permeates broadly into the economy and causes some sort of a sharp slowdown. There's some talk like this is going to potentially impact economic activity very seriously. That's not our view. Finally, it's events in the Middle East are pretty darn clear what's happening with this kind of higher risk world. We used to be a bipolar world with kind of the US dominating and providing a sense of stability. It's now fragmenting into a multipolar world. And this again has been a theme of ours for a while. Gold and Bitcoin, I think, are strategic hedgers with a longer term view. Short term, gold's done very well. It didn't provide much of a hedge when Iran started, but from a longer term view, that I think is a pretty cool part of portfolios. Last point is something to think about. Over the last few quarters, you've seen this in this multipolar world, we're trying to focus on reshoring production, safety of supply chains. Commodities have added value. I mean, most recently, energy being a very stable source of performance in portfolios. Something to think about. This is not an area that people have added to, and so that requires some thought. But leaving with that last kind of food for thought on the commodity side.